Hi everyone, welcome to the channel. Today we'll be looking at the company Acuity Brands, ticker AYI. They are a lighting and building management solution company and also a component of the S&P 400. We'll be looking at the stock valuation, and at the end of the video, we'll go into computer modeling to forecast their 52-week stock movement. But first, this is a company I do own, so we'll look at my recent purchases as well as previous purchases as I have sold in and out of this company before. So let's jump right into it. Here we are in Excel looking at my purchases of Acuity Brands, and at the top in gray was my previous buy and hold for the stock. So I bought it in October of 2020 at around $93, and I did sell it about a year later, actually in September of 2021. And in that period, it gone up about 90%. And compared to the S&P 500 at the time, which only went up about 29%. So Acuity Brands had a big payoff for me, almost tripling the return I would have had if I went into the S&P. So at the time when I evaluated it, I believe it was around $150 I had it, and I sold out around $175. Now, after I did sell out, it did go up more, up to about 200, but since then it has dropped, and we can see down below is my most recent purchases when I got back into the stock. So out in April of this year, I bought in, and we can see around $159 and currently trading at $180. So far this year, it's gone up just under 14%, while the S&P 500 during the same time period has gone up about 4.5%. So again, AYI has been paying off for me over the past 8 months or so, and I do plan on continue holding this at least for the near term. Not sure how long I will own it for into the future, so we'll get into that a little bit more once we jump into the valuation. And we can see here down below my current investment in Acuity Brands started around just $6,200 and currently around $7,200 with the 13.5% gain. So still performing nicely. Not as well as it did back when I purchased it in 2020 of October, where it went up almost 100%. See here in the 90% range, but still, based on the current market situation, I am satisfied currently with this 14%. So let's jump over into the valuation now. Looking at Acuity Brands financial data, first thing that jumps out is their fiscal calendar, which does not match a typical calendar year. We can see they go from August to August. And when I recently purchased back into the stock in April of this year, I did not have the 2023 data. I based everything off of 2022. But some key data points here that I look at, we can see first three: revenue, net income, and earnings per share is actually slightly down this past fiscal year. Not a major decline, but still down. So something I will track in the coming months, or at least next quarter or two, to make sure it's not a trend from quarter to quarter. Uh, However, moving on to dividends, we can see here that their dividends has stayed constant over the past 10 years, so they have not increased it, though I typically like seeing companies that pay a dividend to increase them over time. But with the share count, though, we can see back in 2014, 43 million shares, and now currently down to 32.5 million shares. Yes, there was a slight uptick in 2015 and 2016, but besides from that, they purchased back about 25% of the outstanding shares. So that's something I really like to see in the company. And maybe one of the reasons why they're not paying those dividends or increasing the dividend is because they're using the money to buy back shares, hopefully at valuations they deem are undervalued for the stock. Moving on, book value per share, we can see generally up over the past 10 years. 2022 was slightly down, but still has grown nicely over this time. And then free cash flow and free cash flow per share. We can see it's generally been increasing. Yeah, there was 3 down years, but overall it's been up. And actually, this past year, it's significantly jumped from the prior year, which was the second year in a row when it was down. So some mixed data points, but overall, I am liking what I'm seeing here. And a few other items I like looking at is net profit margin. So typically I like seeing that over 10%. They're slightly lower, more in the 9% range. So a slight concern, but still not anything too major. And then return on equity. So they're in the electronics equipment industry, which typically averages around 13%. And we can see here they're typically in the 15 to 20% range, except in 2020 when they were at 12%. So probably had to do with COVID. So I'm looking at the return on equity, kind of outweighs the net profit margin. That's a little under what I like to see. So again, overall, I do generally see most of this as positive, though there are a few mixed results. But let's scroll down a little bit and we'll look at some of these data points on a graph. It's a little easier to see. And the first thing we're looking at here in white is the revenue per share. And we can see this has grown nicely over the past 10 years. And that's what I want to see with these data points that are based on a per share valuation, is that they're growing up and to the right over time. I don't want to see anything too dramatic in the growth, just a nice steady incline. Earnings per share. So we know this past year earnings per share were slightly down. So that's the one in green. But overall, it has been up except for this prior year. And due to the graph access, we can't really see the earnings per share so well like we can with the book value and revenue per share. And same thing with free cash flow per share. We know that's been growing, but a little hard to see on this graph. And let's move on to return on equity. So as we mentioned, it's typically in the 15 to 20% range. And we can see that here. Yes, 2020 was slightly down, and net profit margin in purple been averaging just under 10% in that 9% range. So all those per share values, though, we can see kind of going up and to the right over time, which is really what I'm looking for. So with that, let's actually move on to the valuation itself. All right, so we can see last time I did a valuation on this company was in December of last year. So you can see that in gray here. And with a 85% margin of safety, I was giving it a value of just under $179. So this is what I was based it on when I purchased back in this past April. However, with their most recent financial data, I am updating the valuation, and we know that some of their data points have been down: revenue, net income, earnings per share. So we can see here with the same margin of safety, 85%, my valuation is slightly lower at just under $175. And this is based on a 8% growth rate over the next 8 years. And thereafter, it would be a 3% growth rate with a 10% discount rate. And without taking into the margin of safety, my intrinsic value is $205. So right now it's trading at $108. So I'm going to continue holding on, see how everything pans out, see how the next couple of quarters go, and make a decision. Also, some other data points I like looking at is this return on invested capital. I like seeing over 10%, and we can see here they're averaging over 13% for the various time periods listed. Book value, not as well, mostly under 10%. Not sure what's going on with my earnings per share data points here. It's not populating correctly. Sales growth, again, not performing as well as I would like. But then free cash flow per share, we can see has performed nicely this year over year. As we mentioned a few moments ago, it's almost doubled. We know they had 2 consecutive years of down years. So this past year, they definitely made up for that. Yeah, over the last 3 years, slightly lower than I want to see, but when we look at the 5 and 10 years, it's up above that 10% range. So again, return on invested capital is one of my more important data points to look at, and they perform very well on that, and a little mixed on the other ones. Well, let's go down a little bit further, look at some other data points. And we look at first the PE ratio, so 16.6. So not really a deep value opportunity, but still in that value opportunity range. Long-term debt to free cash flow, I like to see under 3. We can see they're under 1. So Acuity Brands does not hold a lot of debt, which is another great data point I like to know. Dividends, we know that hasn't increased over the past 10 years, so that's zero. And share count. So I estimated the share count to be down 25%, and it's slightly lower at just over 24%. But still, uh, great data point here with them buying back shares over the next 10 years. And net profit margin, as I mentioned, I really like seeing over 10%, and they're slightly under in that 9% range. So overall, I see these data points mostly pointing in a positive direction. Yes, there's a few mixed signals here and there, but overall, mostly positive. And when that stock dropped to under $160, I thought it was a great opportunity to buy into. So now let's jump over to the computer modeling to forecast the 52-week stock movement. In the computer modeling software, I already ran the analysis using two methods. The first is the M5 rule shown here. And as of this most recent Monday, October 9th, the stock closed at $181.94, shown in the far right column. The column right next to it is the S&P 400 ETF, and that was at 457.38. The other columns are just other various data points being used for the analysis. And as I scroll down over the projections for the next 52 weeks, I'm seeing a lot of fluctuation with this analysis, and actually projecting out in October of next year, the stock being down from where we are today at $161. This is slightly higher from when I purchased in at earlier this year, which was about 159, but it is forecasting being down from where we are today. Now, let's jump over to random forest, the other method, and see what that projection looks like. And same thing here, October 9th, this most recent Monday, the stock closing at $181.94. And as I scroll down, I'm not seeing as much of a fluctuation using this method, but still out in October of next year, it's also showing it to be lower from where we are today at $166 and about 67 cents. So slightly higher than the M5 method, but still lower from today. So let's take both of these results. We're going to put them in Excel so we can look at this on a graph. It's a little easier to see on the stock changing over the next 52 weeks. Back over in Excel, I have the M5 rule graphed. So the vertical red line, that represents this most recent Monday, October 9th. And everything to the left in blue is the historical stock price, while to the right of the vertical red line is the forecasted stock price, which in this case is the M5 rule. The faded orange line, that just represents the percent change of the stock price movement over the next year. But first, let's look at the stock history, and we can see right in the middle there in the 2016 time period, the stock had a nice run up to about $275 a share, but then dropped off over the coming years with a couple of spikes here and there, eventually hitting the lows during COVID in 2020. And we can see out around October of 2020, it started ticking back up, and that's when I first purchased into this stock. And we could see it ran up to over $200 again, probably in that 220 range. But I actually sold before that, and it has come down since then, and it's been in that 160 to $200 range. And we can see here over the past couple of months, from about April to September, it's been kind of flat, about $160, $170, and it just recently jumped up to the $180 range where we are now. And looking at the forecast, it's showing a lot of price movement over the coming year, but not breaking $200. Probably just below 200 in that 190 range at most. But by the end of the year, it is showing it dropping back off again, getting back down to just over $160. So if that does happen, where we are today at about $180, it will be a decline of about negative 11%, minus 12% range. So looking at this, if this stock hits in that $190 range, I'm really going to consider selling out and waiting and see if it drops back down again. Uh, right now, I'm up about 13.5%, if I remember correctly. And if it does get to a 190, I'll be up about 20%. So I'd probably consider selling if I see that. But let's jump over to the random forest graph just to see that stock movement over the next 52 weeks. All right, here we are looking at the random forest, and what I'm seeing right away is it's showing the stock going to go on a decline. And actually, in November, January of next year, it's going to have a steep drop going below 150 for a time period, but then recovering, probably getting back up to the 160 range, maybe hitting 170 at times. But out in 52 weeks of October of next year, it is down from where we are today at about $167 it's forecasting. So that'll be about a -8, -9% return from where we are today. But let's take the average of these two. I like looking at that. To me, it helps give a good indication as one is usually a little more bullish than the other. However, here, the 52-week outlook are both pretty much the same, but the path to get there in between actually is different between the two. So let's just look at the average for a moment. Now that we got the average of the two methods populated, it's obvious that the 52-week outlook is going to be negative, and it's showing about a -10% from where we are today. But it is showing there will be an uptick, maybe not hitting $200, but getting into the high 180 to 190 range. And as I mentioned, when we look at the M5 rule, if I do see that, I'm going to look at selling and buying back in when it drops, maybe hitting below 170 in that 160 range. So I do see that opportunity, and if I am able to sell at about 190, that would give me about a 20% return from when I purchased back in early April of this year. So to recap, the M5 rule is showing a little more bullish, at least over the next couple of months. However, out in 52 weeks in October of next year is actually going to be lower at about $161, though the time in between, it is showing getting in the 190s, maybe hitting 200 or just breaking 200. And again, if it hits that 190 range, and especially if it hits 200, I'm going to look at selling, taking my profits, and waiting to see if the stock drops again. While random forest not having as much of a price movement as the M5 rule, it does have a 52-week outlook that's slightly higher at $166, $167 range, and also showing a bigger dip in between, actually falling below 150. And the average of the two probably leaning a little bit more towards the M5 rule, as that projection does show it hitting around 190, not quite the $200 range where we saw with M5, but still 190. Wouldn't mind selling out and then buying back in if that stock drops down to the $160 range. So I hope you enjoyed the video and got some benefits, and consider subscribing to see future videos.